Welcome to The Explainer. Today we're totally unpacking the 2026 valuation outlook for Occidental Petroleum, better known to most of us by its ticker, OXY. We're going to figure out if this company is setting up to be a highly profitable cash-flowing value stock or if it's really just a cyclical commodity trap waiting to catch unsuspecting investors. There's a lot of nuance to this one, so we're going to break it all down step by step.
Here is our game plan. We'll define what OXY actually is, dig into their history with leverage, weigh the major risks against the upside, and wrap it all up with Wall Street's final verdict. Let's get right into it.
Section 1. What is Occidental Petroleum? We really need to establish exactly what kind of asset we're dealing with here.
Listen, OXY is absolutely not your typical smooth-sailing growth stock. This isn't some tech giant that just predictably compounds year after year. No, this is a high-beta, cyclical energy business. What that means is its earnings, the overall investor sentiment, and its valuation multiples swing wildly based on three things: oil prices, leverage, and capital discipline. They have premium U.S. shale exposure, specifically a massive footprint in the highly coveted Permian Basin. And historically, the management team knows exactly how to squeeze cash out of those assets when the cycle is in their favor.
So, bringing it to right now, with the stock hovering around the $60 mark, the market is showing some confidence in their financial recovery, but it is certainly not handing them an overheated premium valuation. When you compare this to past peaks, it doesn't look overly expensive, but it's not deeply distressed anymore either. The market is pricing it exactly as what it is, a cyclical oil producer with improving financial flexibility. Why this matters to you is that at $60 there is a real opportunity, but your safety net depends completely on broader market conditions.
Moving on to Section 2, the history of leverage. To grasp today's price tag, we have to talk about the ghosts of OXY's past.
OXY has a serious track record of debt-fueled expansion. Remember that massive Anadarko acquisition? Yeah, that closed right before the 2020 crash. Talk about brutally bad timing. It loaded them up with financial risk right as oil fell off a cliff, and that permanently scarred investors. Fast forward to the present day, and the recent Crown Rock deal triggered all of that historical anxiety all over again. Strategically, sure, it strengthened their Permian position, but psychologically, the market is definitely having flashbacks to that heavy debt load.
Because of all that baggage, the market is demanding a trade-off. Wall Street gives OXY full credit for having top-tier, incredible assets in the Permian, but they want proof. They are aggressively demanding consistent, hard proof of debt reduction before they'll push this stock into a higher valuation tier. Having phenomenal assets is great, but a clean balance sheet is the only key that will actually unlock this stock's value.
Section 3. The major investment risks. Let's flip over to the bear case and see what's dragging down the scale.
Okay, so what's the biggest immediate risk here? Without a doubt, it's oil price downside. If crude weakens, debt reduction grinds to a halt. Then there's the execution risk. Management absolutely must prove they can pay down this debt through cash flow and asset sales. Add in the big capital allocation question mark. Are they going to reward shareholders or just chase another risky acquisition? Combine that with operational hurdles like potential well productivity drops or rising service costs, plus long-term environmental regulations, and you've got a pretty heavy wall of worry.
It's literally a tale of two completely different realities. On one hand, if oil stays strong and they consistently chip away at that debt, the stock has a highly favorable path upward and estimates will rise. But man, if oil weakens or that mountain of debt becomes the focal point again, earnings estimates will instantly tank. OXY either looks like an incredible bargain or a highly dangerous trap, depending entirely on which scenario plays out.
All right, Section 4, the path to upside. Let's look at the bright side, because the bull case heading into 2026 is actually incredibly potent.
The fastest way to unlock value here? Rapid debt reduction. Every single dollar they pay back crushes financial risk and builds investor trust. Second, if oil prices stay firm, thanks to tight global supply or OPEC discipline, OXY's free cash flow is going to absolutely explode to the upside. Then, if they can smoothly integrate those Crown Rock assets, they'll boost efficiency across the board. Once leverage is down, they unlock the magic phrase, shareholder return optionality, dividends, buybacks. That's the engine for this thesis. Do all that, and the market repairs the multiple, finally treating OXY like a disciplined cash flow machine instead of a risky, leveraged bag.
Now, I do want to quickly address their environmental investments. OXY is spending big money on low-carbon projects and carbon capture. But let's be real. You have to treat this as an optional, long-term bonus. It is not the core reason to buy the stock today. These projects are execution-heavy and totally dependent on government policy. If the tech and the policy economics improve, it's a fantastic differentiator. But right now, this stock's fate is completely tied to oil cash flow and paying down debt.
Section 5. Wall Street's final verdict. So how are the pros balancing these historical risks against the clear upside?
Right now, Wall Street is playing it incredibly safe with a hold-heavy consensus. We're looking at a massive block of 15 holds compared to just 7 total buys and 3 sells. It's a classic wait-and-see situation. Analysts know the assets are world-class, but they absolutely refuse to call this a low-risk bargain just yet. They are actively guarding against the volatility.
The divide in the reasoning here is super clear. The buyers are betting on the balance sheet getting fixed, successful Crown Rock synergies, and a tidal wave of free cash flow if oil holds up. The sellers? They are terrified of the high leverage. They're worried about cyclical earnings dragging everything down, and they think the market might be pricing in an overly optimistic perfect scenario.
So what does this all mean? Ultimately, the entire 2026 outlook boils down to one single question. Is management going to prioritize paying down debt, or are they going to get itchy and chase another risky expansion? The cash-generating potential here is mind-blowing, but discipline, simple self-control, is the deciding factor between a massive value creator and a painful commodity trap. So ask yourself, are you willing to bet on Oxy's newfound financial discipline, or is the ghost of their debt-fueled past just too scary to ignore? Thanks for tuning into The Explainer.